Have you ever wanted to make a significant purchase, perhaps a new home, but felt uneasy about conventional financing options and their interest charges? Well, understanding Murabaha can open up a Sharia-compliant path for you. Murabaha is a type of Islamic financing contract where a financial institution purchases an asset, such as a home, and then sells it to you for a pre-agreed, deferred price that includes a transparent profit margin. It is essentially a cost plus profit sale, allowing you to acquire assets without engaging in interest-based loans. The fundamental principle behind Murabaha is the avoidance of riba, or interest, which is prohibited in Islamic finance. Instead of lending money and charging interest, the financial institution acts as a merchant. They first acquire full ownership of the desired asset from a third-party vendor. This direct ownership by the financier is a crucial distinction, as it shifts the transaction from a loan of money to a sale of goods. The institution then sells that exact asset to you at an agreed-upon price, which includes their original cost plus a clearly disclosed profit amount. This structure ensures that both parties know the full cost upfront and that the transaction is based on a real asset, not on the time value of money, which makes it permissible under Islamic law. When considering Murabaha for a home purchase, the process typically begins with you identifying the property you wish to buy. You then approach an Islamic financial institution, which will purchase the home from the seller on your behalf. Once the institution owns the property, they will sell it to you at the higher, agreed-upon Murabaha price, which you then pay back in installments over a set period. It is important to carefully review the payment schedule and the total price to ensure it aligns with your financial plan, as this forms a binding contract. An important insight into Murabaha is its emphasis on transparency and asset ownership. The financial institution must clearly disclose the original purchase price of the asset and their profit margin to you. This is known as a cost plus profit arrangement. Furthermore, since the institution temporarily owns the asset, they bear the risk associated with that ownership during the brief period before selling it to you. This is a key differentiating factor from conventional loans where the bank typically does not take ownership of the asset. This unique structure ensures fairness and adherence to Islamic principles. Ultimately, understanding Murabaha means recognizing a powerful and ethical alternative for acquiring major assets. It provides a structured, Sharia-compliant way to achieve your financial goals, replacing interest with a transparent, mutually agreed-upon profit margin on a real asset. This method allows you to make significant purchases with peace of mind, knowing your transactions align with your values.